Good morning, it's me, Kenny Polcari, your host of the party, and today is Wednesday, February 8th, 2023. And what's going on? Well, we had JJ presenting yesterday, we had Joey giving the State of the Union, we had oil all over the place, we had tech all over the place. It was a crazy day. But let's talk about what it is you need to know, right? JJ said absolutely nothing new. He remains hawkish, yet investors apparently heard dovish. Stocks surged, and big tech gets an even bigger boost from artificial intelligence. Biden launched his 2024 campaign last night, targeting anything big, and we'll get to that in a moment, while oil surges higher. Oh boy, considering he thinks you only need it for another 10 years. Treasury yields rose. Short duration continues to be a very interesting place to put some cash. And I guess it's time for the champagne chicken. We're going to have that in just a moment, and it is very good. Okay, so JJ took to the podium, right? And for some reason, some investors appeared to be confused. Was it dovish? Was it hawkish? Is the Fed pausing or not? And what about the pivot that was supposed to be coming? Hello? Maybe you haven't been listening to the conversation, or maybe you've been listening to the wrong conversation. The only ones that have said the pause and pivot are coming are trader types and some bond gurus. No one at the Fed nor anyone on the FOMC committee has indicated any such thing. In fact, I would argue that they have gone out of their way to make sure the message remains clear and decisive. The Fed has said that a strong labor market continues to present a problem for them, and that the current thinking on how high rates need to be might actually need to be reconsidered to the upside. Yesterday, the message was very much the same, right? JJ alluded to the fact that disinflation has begun. That's great. That was the dovish part. But then he repeated the fact that further rate hikes, plural, not singular, will likely be needed if the jobs market does not cool off. That he may have to do more than what the markets and investors and algos and any of the artificial intelligence assumes. Now, I believe that 2 more rate hikes are already baked in, right? But I'm not sure that 3 more rate hikes are baked in, and that's now the question. Does the Fed move in March and May, or will we also see a move in June before they pause? That is the question, and that's kind of what's going to unsettle markets, I think, down the road. Because the market right now thinks that's not happening. The reaction in the markets was curious. First, they rallied when they thought he was turning dovish. Then they plunged when they realized maybe he was more hawkish. Then they rallied to unchanged as they decided to listen to the whole presentation before trying to handicap how the markets would react. By the end of the day, those stocks did end the day higher. And why do you think? Because the market remains convinced that he is wrong and the markets hear what they want to hear versus what they should hear. Many in the media now pointing to the fact that JJ passed up the opportunity to slow the enthusiasm for stocks, bonds, and other assets by not being more specific, leaving some out there to say, see, I told you so. By the end of the day, the Dow gained 265 points, or 0.8%. The S&P added 65 points, or 1.6%. The NASDAQ tacked on 226 points, or 1.9%. The Russell added 18 points, and the transports gained 125 points, or just under 1%. Now remember, I pointed out in yesterday's note, and I've been saying it for a while, that not only did Atlanta Fed President Rafi Bostic say the same thing on Monday, but then Minneapolis' Neely Kashkari reiterated it again yesterday at 6:45 a.m., 3 hours before JJ took the stage, making sure that he got some airtime to help secure his own credibility and let the markets know that he has to be taken seriously. While Rafi called for rates to go to 5.1%, Neely's calling for rates to go to 5.4%, which means 3 more 25 basis point hikes at the least to get us into that range. Recall, Rafi said that he would not be surprised to see the Fed go 50 basis points at the next move. And so it is what it is. But don't forget, the key driver since the October lows was the idea that the Fed would not do what they say they are going to do. Just like they said that when the CPI pierced 2%, they were going to stop the prices and begin to normalize. Okay, that was April 2022. And what did they do? They did not stop the presses. They continued to stimulate the economy. They continued the bond buying program that helped to push inflation to 40-year highs on top of all the money that the administration spent. I was 22 the last time this happened in 1980, and it wasn't pretty then either. In fact, for those of you that don't have a memory of that time, it was downright ugly. The Fed pushed the economy in the country into a 2-year recession. Interest rates peaked out at 21%, inflation peaked out at 13%, and the unemployment peaked out at 10%, while the Dow Jones bottomed at 792. Yes, 792, that is not a typo. And then after JJ got finished, the conversation turned to what Joey was going to say at the State of the Union. How he would massage the facts to create the story of health and strength for both the economy and the country, which all politicians do, so that's not necessarily anything to, put your finger at. Talking about how the massive spending packages that they passed is doing a fine job of killing inflation. Never mind that the cost of all this debt, new and old, is going to send interest payments on this debt to more than $1 trillion a year, right, in payments, interest payments. He talked about how bad the economy was and how inflation had already begun when he took office. Okay, just a quick fact check here. GDP was better than 4% when Joey took over. It's now running at 3%. And inflation was 1.6% when Joey moved into the White House in 21. Only to go to 9.4% by the summer of 22, a full 16 months after he took the reins. So tell me, how exactly did the prior administration be responsible for soaring prices? I mean, that's really a rhetorical question. There's really no need to answer it. I'm just tossing it out there. He then told us to expect to use, that we're going to use oil just for another decade, just for 10 more years, and then we're going to be done with oil before we convert to everything alternative. And then he went on to reprimand the oil companies for not investing more money into oil infrastructure. I mean, it's illogical. But here's a quick fact. Why would oil companies make capital investments that amortize over 30 plus years if we only need oil for another 10? It's illogical. So the oil companies decide to plow their profits back to shareholders via dividends and stock buybacks. So if you own oil stocks, you appreciate the insight and you appreciate the fact that these companies are going to reward you, right? And if you have a retirement plan, company-sponsored or an individual IRA, and you own the S&P Total Return Index, or you own the oil sector specifically, then guess what? You too like the fact that oil companies and other companies are returning profits to shareholders via these two methods because you benefit. He then launched his 2024 candidacy when he told the nation that Republicans want to sunset Social Security and Medicare. Are you nuts? Which is a complete untruth. Let's just call it an untruth. And which was met with anger by the GOP, and it should, right? It's irresponsible for a president of the United States to say that and then not expect to be called out. In addition, he's taking aim at anything big. Big tech, big pharma, big business, big oil, big earners. Think billionaires. So get ready for the Biden somebody ticket in 2024. And let's keep our eyes on those sectors today, big pharma, big tech, big oil, to see how investors are reacting to the shot that Joey took last night about those companies, about those sectors. He spent nearly zero time on China, one sentence, and he never even mentioned the incident. He did not even mention the threat that China poses to Taiwan and then what he or we would do if that event happens. He did mention the fact that big tech is moving manufacturing production of semis to the U.S. so that we would never run into a supply chain problem for chips ever again. The first plant to be online by mid-2025. So let's just hope that China holds off taking over Taiwan until we're ready to go. Something I don't think is happening, which is why I'm continuing to look at aerospace and defense. But we'll talk about that in a minute. The rebuttal was delivered by Arkansas Governor Sarah Huckabee Sanders, who is the youngest governor in the country, responding to the oldest president that the country's ever had, right? She held nothing back, nothing. She called out all the misinformation, did some fact checking on nearly everything he said. So expect all kinds of chatter and discussion about both the speech and the rebuttal. So as you can see, earnings in EcoDaddy yesterday meant absolutely nothing. Only 3 sectors ended lower. Consumer staples and real estate, both down 0.4%, and utilities down 0.1%, right? Because those are the defensive, boring plays, right? Energy, which has been the underperformer this year, rallied hard, rising 3.25%. Tech rose by 2.5%. Artificial intelligence rose by 2%. Think the mania over ChatGPT and Bard and Ernie. And that sent Microsoft up 4.5% and Google up 4.4%. Cybersecurity names up 2%. Disruptive tech gaining 1.7%. Oil services stocks, the OIH, gained more than 2.3% and it is up 40% year to date. So you think Halliburton, Schlumberger, Baker Hughes, to name just a few. All up more than 25% year to date, with Slum up more than 40%. Semiconductors gained 3%, leaving that group up 25% year to date. And the growth trade, SPYG, outperformed the value trade, SPYV, by a good 70 bips. And that makes sense. Just look at what all the different tech sectors did yesterday. They rallied hard. Those are considered growth trades. And if you were betting on a decline in the markets yesterday and you went long the contra trades, the ones that get you short the market, you were sorry you did because they all moved lower. The small caps and the mid caps, though, held their own. Dividend aristocrats like Noble and Regal also gained, adding about 0.3%. It was a very interesting day for sure. Now, oil, what happened there? It surged by 4%, 4.3% actually, and pierced the trendline resistance at 77.30. Well, let's revisit this. Oil's been stuck in the $72, $82 range since early December. When it gets into the 80s, they start talking about demand destruction and global recession, calling for a $60 barrel of oil, and that sends oil lower. And then when it gets to the low 70s, they change the narrative, and they talk about how China's reopening is going to cause demand to surge. Oh, and by the way, the Saudis are then banging the drum, signaling production cuts are just around the corner, and suddenly oil's going to trade at $100 a barrel, and boom, up it goes. Well, folks, they did it again. Demand destruction on Thursday and Friday, and then on Monday and Tuesday, it was all about demand creation. And how forecasted increases in demand in Asia, think China, are causing the Saudis to raise prices for their flagship crude product into Asia because of the expected surge in demand. The Asians want more, so the Saudis are happy to give it to them at higher prices, which must mean the China reopening is real until they decide it isn't, right? In addition, we had some one-offs, right? We had that earthquake in Turkey, which shut the terminal down in Ceyhan. I think that's how you pronounce it. Bad weather in Iraq prevented some tankers there from berthing. And the shutdown of the Johan Sverdrup oil field in Norway also helped to boost prices. But those are short-term events, but they are events just the same. This morning, oil is trading at $78, up another 1%, getting awfully close to that $80 figure again. So let's see what they do now. Treasury sold off as money moved into stocks, sending yields up. The 3-month Treasury bill now yielding 4.5 on an annualized basis. The 6-month yielding 4.7% on an annualized basis, while the 2 years yielding 4.43. Expect to see more and more investors pour money into the fixed income on a short-term duration basis when the mood for stocks changes, right? And it'll change. Trust me, it's going to change. EcoData today is about mortgage apps and wholesale inventories. Absolutely nothing that's going to drive the action. The dollar index, the DXY, continues to bounce, right? It piercing trendline resistance at 103.50 yesterday, having bounced all off the lows of 101 last week, a level that it tested in May and June and one that I thought would hold. We now have to see if the latest move up and through resistance is going to hold now. Will resistance now become support or not? If it fails, it's likely to test the 101 support level zone again. A push higher is going to see us test the longer term resistance at like 107.10. So that's kind of where we're at. I think it's actually going to push a little bit higher, but let's see. Gold kissing 1900 after testing and holding support at 1868 earlier in the week. A push here will see a test, a push up and through 1900 is going to see a test 1930 before we need to reassess. U.S. futures this morning are lower. No real surprise. Dow futures down 120, S&P's off 17, the NASDAQ down 35, and the Russell's down 12. We've got a slew of earnings announcements. We had 8 so far, and they've all beaten the estimates. Uber quoted up 50 cents, while CVS is quoted up $2. The big one that everyone is talking about though today is Disney, and they come out after the bell. So expect lots of talk about Bob Iger being back and blah, 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 and everyone's so excited. Disney's up on the year and how great it all is. Have you been to Disney lately? If I never went back, that wouldn't be a problem for me. The S&P closed the day at 4164, up 53 points. And while I do expect some churn and consolidation, it doesn't feel like it's going to happen just yet. We're still holding well above the 4,000 point trend line on the S&P. And if they want to take them higher, I'm happy to go along, right? I'm happy to go along for the ride, and you should be too. I am not chasing anything, though, up here, but rather trying to identify where the next opportunity is. And I'm looking at aerospace and defense names like Raytheon, Lockheed Martin, General Dynamics, and Northrop Grumman. Why? They're flat to lower on the year, and that doesn't make any sense to me considering the global mood. But that's me. Remember, build a strong foundation, dollar cost average into it, keep reinvesting all the divvies. That's the plan, unless, of course, you need the money for income. Otherwise, reinvest it. Buy names on weakness. That's the way you do this, Warren Buffett style, as long as the weakness is not a fundamental shift in the story, in the sector, or in the name. Okay, what do we have for dinner tonight? We're having a chicken breast and a champagne cream. Why? Because apparently it's time to celebrate, so break out the champagne. This is a classic dish. Easy to prepare, presents beautifully on your plate on a bed of sauteed spinach. Will leave your guests wondering, how did you manage to pull this off? So you want to start with skinless pounded chicken breast. You can use thighs if you want. Dark meat is always sweeter. Dredge it in seasoned flour with salt and pepper. And after you've dusted the breast, you want to just set them aside. Dusted them in the flour, just set them aside. On medium heat, in a big saute pan, heat up like 3/4 of a stick of butter and a splash of olive oil in the large saute pan. When it's nice and bubbly and almost sizzling, yet not burning, add the breasts and saute for about 4 to 5 minutes on one side. At this point, turn them over, let them saute for another couple of minutes, and then add about 1.5 cups of champagne and let them sit there for about 10 more minutes, right? The heat, the alcohol will burn off and it will reduce. Now, after that, you're going to add about 3/4 of a cup of heavy cream, light cream if you must. You want to add chopped Italian parsley and a bit of rosemary powder and continue cooking it until it thickens up, right? Turn the heat down, though, because you don't want it to burn. While it's cooking, you want to saute some fresh spinach and garlic and oil and then make a bed of spinach on the plate. When the chicken is done, you want to transfer the breast to the individual plates, put it on top of the bed of spinach, and then top it with the champagne cream sauce. Delish. You want to make a nice mixed green salad, garnish with cherry tomatoes, red onions, cucumbers, dressed in a champagne vinaigrette, right? And that will finish off the meal. Choose a lighter bodied red or even a chilled white wine to complement the presentation. For this, if I was going to go red, I'd go with something simple like just a Chianti. If I was going to go with white, you know me. Do I have to tell you again? It's Pinot Grigio Santa Margherita. In any event, look at this. I took that stuff off my windows now, right? So you can actually see outside. It's kind of an interesting day. It looks a little bit cloudy, but the sun is supposed to come out, and it is supposed to be about 80 degrees today, and it's going to be a beautiful rest of the week. But until tomorrow, take good care.